going to do some math because we're going to talk about the magic of adjustable rate mortgages, also known as ARMs, and why when rates are high they can make a lot of sense for home buyers to consider. So we're going to jump right in and talk about them. And I think when I talk with a lot of folks about ARMs, I'd say about 50% of them aren't really even considering ARMs because they think they're too complicated or too risky. And today we're going to talk about that and decide whether or not they really are all that complicated. Hint, they're not. And whether or not they're all that risky, and a lot of them are also not. So we're going to talk about that and see if we can help get you on your journey to understand this really important financial product. So when rates are high today and they might be going down tomorrow, that's usually the best time to start looking for ARMs. First of all, there usually tends to be the biggest gap between the fixed rates and the adjustables once the market is expecting the rates to go down. But as long as you're willing to absorb a moderate level of risk, you can save thousands of dollars over the term of these adjustables and build equity faster. And we're going to jump into a spreadsheet and I'm going to show you exactly that. So obviously I recommend that you refinance these loans because of the amounts of money involved before they get to the end term. That's really the one big takeaway. If you decide to go to an ARM, you need to keep in mind. If you have a 7-year ARM, if you get a good opportunity in year 3, year 4 to refinance, don't wait till the end of term. Refinance in the middle of year 3, year 4, and get that extra term. Okay, get into a 10-1, get into a 30-year fixed. And full disclosure, I've never had a 30-year fixed mortgage. My wife and I have owned 3 houses, and I've never been pressured to get out of a particular loan just because the term ended. Something always happened where I ended up refinancing anyway. Usually it was because the rates went down and it was a really great time to refinance. So, but in order to get past the lingo, the way that people talk about ARMs, I'm going to spend some time on this slide so that we can talk about them. So adjustable rate mortgage, first of all, you'll notice I call them ARMs. Mortgage guys call them ARMs. That's just what we call them. So if you hear them say ARMs, that's what they're talking about. They're talking about adjustable rate mortgages. And we usually refer to them by their type. And there are many different kinds of adjustable loans. There are so many. But the main ones that are out there are 10-1s, 7-1s, and 5-1s. Most of the time you can find those products. So banks have a lot of different takes on what their ARM should be. But let's talk about it. What does a 10-1 ARM mean? Well, believe it or not, an adjustable rate mortgage is designed to be paid out over a 30-year time period, but it's paid out a little bit differently. But the first number, the 10, the 7, the 5 in my examples here, those work just like 30-year fixed mortgages. Okay, so basically, even though it's called an adjustable rate mortgage, it doesn't adjust for that first number in terms of years. So if you have a 10-1, the rate, your payment, nothing changes for the first 10 years. It works just like a 30-year fixed. It's that 11th year that things change. Well, how do they change? Well, the way that it changes is after that it becomes adjustable. And with any loan, you really have to read very carefully to see how much change it can be. But usually they can adjust a certain amount up or down. And believe it or not, sometimes if rates are low, adjustables will adjust down. So my wife and I have an adjustable on an investment property, and most of the time it's been below where we actually did the deal, and we just let it float. So it doesn't really make sense to refinance it because it's done so well for us as an adjustable. But that's a small investment property and not your house. So I'm not suggesting that you get to the end of these terms when they float. But if they do float, they can't, the interest rate usually can't go up 5 points in a year. And so they usually can only go up, a point or a point and a half or maybe even 2 points. But that's a lot, especially if you're borrowing a lot of money, which is why, again, very important that before you get to the term end of these loans, that you have refinanced them into something that's a little bit more projectable, a little bit more stable. So, but at the end of the day, the second number is how often it adjusts in years. And so that's why sometimes you can see a 10-2. So a 10-2 would be something that's fixed for the first 10 years, and then every 2 years it adjusts. But again, most of the time these loans adjust on an annual basis after that fixed period. Okay. Now, I'm going to tell you right now, there are a lot of aggressive loan products out there that I'm not going to spend time talking about, like a true adjustable mortgage that adjusts every year. I don't think, unless you are a significant and serious home investor, that that's the type of product that, a home buyer should be in. It's not a good strategy. Way too much risk, way too little benefit. So that's not something that I recommend. I tend to recommend to my clients, when the arms make sense, that they look at 10-1 arms and 7-1 arms. I've done a 5-1 arm myself. 5-1 is, for the more aggressive folks out there, it can make sense, but you really need to be comfortable with the additional risk that you're taking on. But 7 and 10 years, I don't think that there's really a whole lot of risk. And the reason is simply to do that is because most people, almost nobody, gets to the end of their original 30-year fixed mortgage. And there are a bunch of reasons for that. I mean, first of all, if you do home improvements, if your home value has gone up after 10 years, sometimes you refinance in order to take some of the money out of the house in order to improve the house. That way it doesn't come out of your pocket. People refinance all the time to do home improvements, and when they do it, that original 30-year mortgage gets sent to the trash bin and they get a whole new one. This isn't necessarily a bad thing. It's just you need to understand that it's likely that you're probably going to be in a situation where you refinance to pull cash out in order to improve the property, something which, if done smartly, I definitely recommend that people do. But also simply the fact that the valuation of the property has gone up encourages people to refinance, as well as the fact that sometimes they refinance because their incomes have gone up. Over time, 7 or 10 years from now, I hope everyone watching this video is making more money than they are today. And the truth is, you probably will be. And the other reason that people refinance, of course, is that rates go lower. But a lot of times, if you're in a loan for 10 years, by the time your income has gone up and the balance that you owe has gone down and the value of the property has gone up, it's very easy to jump into a 15-year arm, which a lot of people, a 15-year fixed mortgage, which can make sense for a lot of different reasons. You can really start paying down the equity in the property very quickly with a 15-year. So having said all of that, I'm a big proponent of arms. As I mentioned, I use them myself. But the truth is, if you're really risk averse, if the idea that at some point in time you're going to have to refinance and you don't know when is going to keep you up at night, just do the 30-year fix. This video is not for you, and you can move on, and you can just stick with the 30-year fixed and sleep better. I know there are definitely people who are out there. Arms are not for everyone. I just think that they happen to be a great product. All right, so that's our primer for arms. Now we're going to jump into the spreadsheet, and we're going to take a look at exactly how an arm saves you money and helps you build equity faster. Let's go. Okay, so now we're going to dive into the spreadsheet. Don't get nervous. I know it's a lot of numbers, but most of them don't matter. I'm just going to show you how I set it up to make sure I did all the calculations, which I'll do quickly, and then we'll get to the really important stuff, which is how do we compare loans? So over here, this is the comparison loan, okay? So these are your 30-year mortgages, and these are your 10-1 arms, which we've talked about, the 7-1 arms, and the 5-1 arms. Now, they're all going to have different interest rates. Okay, so you can see this is the interest rate for the 30-year. It's the same in both these columns, the 10-1, 7-1, and the 5-1. Now, these rates move all the time, and they don't. Sometimes the 5s are a good deal, sometimes the 7s are a good deal, sometimes the 10s are a good deal. It's really hard to tell what they're going to be tomorrow, but these are basically what they were today when I did the spreadsheet, and they give you an idea of the kinds of differences that are out there. So, and over here, this is just the loan amount. Now, what I did is I calculated what the interest payment was in month one and the principal payment was in month one for each one of these loans. And that's so that we can compare the totals when we get down to the bottom. So after you do all that, let's go down to the bottom. So The first one we'll look at here is the 10-1 ARM. So this is 120 months, which is 10 years. And if you add up everything in this column, you can see it all highlights. Then you have paid $276,000 in interest. I know it seems crazy, but that's what you do when you do $2,000 and change dollars a month for 10 years. And you've paid down $53,000 in principal. But if you had the 10-1 ARM, okay, which has just a slightly lower interest rate in this particular model, you've paid $262,000 in interest. That's $13,000 less in interest. You don't want to pay interest, so saving $13,000 is very good. On top of that, you've paid $56,000 in principal. I think this is something that most people skip over when they look at it, and that's another almost $3,000 in principal. And on top of that, your payment every single month was $100 lower, $91 lower, $92 lower. So it seems counterintuitive. Okay, it's not obvious that by paying less, you can actually pay less in interest and pay more in principal. But this is exactly what we have here. And honestly, the 10-1 ARMs today, they weren't really a good deal. If we get over to the 7-1 ARMs, okay, now obviously I can't look at it for 10 years because you need to be out of this loan in 7 years. That's the whole point. But at 7 years, you've paid in the 30-year fixed $198,000 in interest and $33,000 in principal. But with the 7-1 over here, you've only paid $170,000 in interest, which saves you $27,000 in interest over just 7 years. And in principal, you have paid another $5,000 in principal. Folks, this is a tremendous difference. And on top of that, your monthly payment was $260 lower. If you can't find a reason to get excited about a 7-1 ARM, this should excite you. Okay, and this is over 7 years. This isn't over 10 years. So this is a ton of money to save. Okay, and this is really where the magic of the 7-1 ARM works out. It turns out in this particular example that the 5-1 ARM is even better with savings of $27,000 in interest over just 5 years instead of 7, and paying down $5,700 in principal over 5 years instead of 7. So basically the same savings as the 7-year in 2 years less time, and your payment is lower. But as we've discussed earlier, the 5-1 definitely carries a little bit more risk. That's not for everyone, but I think 7 years is a pretty long time. And if I was mortgage shopping right now, I mean, the 7-1, that's the loan I'd try to go after, because the savings there are really substantial, and I'd be willing to make a bet that I'd save so much money over 2 or 3 years that it'd be pretty easy to refinance when interest rates decide to bottom out in the next cycle. So that's a real quick overview of how these loans save you money, allow you to pay down more principal, and why sometimes you want to be looking past the 30-year fixed with a good mortgage advisor who can run these numbers for you. So if you want me to run these numbers for you, as you know, I already have the spreadsheet because you're looking at it. So I'm happy to do those comparisons, and we can talk with them just in the same way as I have them set up here. So just reach out to me in the comments or email me, and we can do that. Thanks. Hope you have a great day.